I judge my managers based on whether or not they did what they told me they were going to do. If
Hmm.
you said you're an enterprise SaaS investor and your portfolio is full of space tech companies, I'm going to ask why. If
Yeah.
you said that you were going to deploy capital over a 24, 30-month period and you're almost done with deploying capital, it's only been 12 months, I'm going to ask why. Like all of the things around the metadata around investing, I think are the questions that we hear a lot from LPs for emerging managers. And then you can talk about performance once these funds get a little bit more, healthy or mature.
Peter Walker runs the insights team at Carta, focused on discovering key narratives across private markets. Prior to Carta, he was the head of marketing for the media analytics company Public Relay. He also led the data visualization team at the COVID tracking project at the Atlantic during the peak of the pandemic. And he and his wife recently welcomed their corgi puppy, Penny, into the family and are introducing her to every one of San Francisco's many parks. How are you doing today, Peter?
Doing great, guys. Happy to be here.
I only stumbled over the intro twice, but there were some interesting alliterations there and a lot going on. But appreciate you coming on. And I know Colin is very excited to chat with you.
I
Thank
mean,
you, Colin.
I feel like
Excited
I'm
about that.
always excited to talk to every guest, Harry.
We have to
Um,
tell every guest that, but we don't
Yeah,
always
that's
mean that,
fine.
do we?
no, I mean it this time because I bother Peter via email and DM probably weekly at this point about data. So he's either really excited to talk to me or probably dreading this a bit. I'm not sure which one. Could be both.
Could be both, Colin. We'll have to find out in the conversation.
Ugh, it'll all come
Great
Peter,
out.
to see you.
Peter, do you consider yourself the Nate Silver of VC data, or how do you describe yourself when people ask you what you do?
Wow. I don't think Nate Silver is exactly the persona that I'm going for. I hope that I'm slightly less combative than that.
Mm,
But no, I don't think, I mean, my job wouldn't exist without the amazing data set that I have to play with at Carta. So that's step one. What do I think of myself in this ecosystem? Like, hopefully the brand is someone who can help founders and managers answer questions, but not with some airy, recently I had a conversation with my friends and they said this, but with like real evidence. So that's been the last 3 years.
What
It is like,
data set?
oh,
Oh, sorry. What data set
no,
do
no,
you have at Carta, Peter? Like what do you guys, who is your customer and how do you sort of describe, what you're looking at?
Yeah, so I think Carta, is best known for its equity management software. That's where we were born and raised, helping founders manage issue equity to investors, to employees, advisors, et cetera. That data set is about, call it 45,000 companies or so, mostly in the US, but quite a few across the world as well. And from that, you get the core fundraising metrics: valuations, dilution, total raised, who owns what percentage of the company. It turns out owning the cap table gives you just a wealth of information, source of truth for what's going on in venture. And then the second data set is around funds. So we also manage the back office for 3,000 venture funds here in the US. And from there, we help them with valuations, reporting, audit, tax, fund administration writ large. And from there, you can get things like the performance of those funds, of course. You can dig into things like their management fees and carry and how that's changing or not changing by fund size, et cetera. So those are the two poles that kind of hold up our view of what's going on across private startups.
it's like well, it's great one because it's like been a notoriously opaque, like just industry. I've been in startups long enough. I remember when Carta didn't exist and most cap tables were on Excel spreadsheets, which I'm sure there's a surprising amount that are
I
still
think a lot
on.
still are.
Yeah.
Still our biggest competitor, Excel.
Who
But
knew
I think that's
Microsoft
true
was
for
in the
like any
cap table
financial-ish
business?
software. What's that?
I said, who knew Microsoft was in the cap table business? Uh,
Microsoft is in many businesses they're probably not aware of, I would bet.
I think, I think there's so many spots to go. And I think, early, like one of the first times we interacted, Peter, I think I asked you a question, mostly probably because I wanted to know if like what I was doing was market or not, but
Hmm.
just about like the average check size, like for angels and things like that, especially at the early stages. And I think one of those like surprising findings that kind of went viral was that I think it was like 25 or 30K was like the actual like median maybe. And that
Yep.
like which means that like half of those check sizes, right, are even smaller than that. Um,
Yes,
I know, and that just highlighted to me like how little everyone actually knows about the ecosystem and like what actually goes on. And like even from the founder perspective, they may just know a bunch of high net worth people, so their round is a bunch of big checks, or it
yep,
might be someone that had to raise a bunch of small checks, and so there's like this probably more than a bimodal distribution, but just like a big like this variance. So I know I've been really that's like been one of the like the things I love about everything you post is that like it's like a little bit of sunshine into what is traditionally a very I don't know dark area.
definitely. There's a there's a thing that we've consistently come across, and we put this data out to the world, which is there's two kinds of reactions that I get to things. One is thank you, that confirms my prior worldview, and now I can take that graphic and show it to people that disagreed with me, which is great. Or if you're a founder, hey, this is distinctly different than what I'd been hearing from my VCs, my lawyers, my friends who are founders. Uh, and actually, I like that second reaction even more because sometimes people don't believe the data because it doesn't agree with their prior. And then they, will come back a little bit later and say, actually, when I went out and did a lot more research, like this does seem to be correct. Thank you for, I now can avoid XYZ outcome that I would have made an error with bad data. So as you said, a little bit of sunshine, a little bit of transparency to private startups goes a long way. The other thing that this data really illustrates, though, especially at the earliest stages, is just how much of this stuff is relationships and cultural and not actually hard numbers. I think early stage venture is, and this isn't always a bad thing, but it is a lot more about vibes than it is about hard numbers in a
Mhm.
lot of ways. And that's something that can be a little bit difficult for a data person like myself to wrap their head around.
Yeah, well, maybe we could sort of start with that earlier stage, as the name of the podcast implies, Wannabe Angels. We talk a lot about angel investing and get into some of the numbers, some of the weeds. What are some things that have stood out to you when it comes to angel investing in early stages from either that founder angel perspective? Is it more around the check size or, who's investing in these rounds or even what is, like Colin, you're mentioning 25 to 30K checks. Is that like depends on your definition of an angel too, right?
Sure. Yeah, I probably spend the rest of the hour or more discussing what is an angel investor and who counts. Is a syndicate one angel investor? How do you distinguish between these things? But to get to maybe some harder numbers at first, I think to piggyback off of what Colin was saying earlier, one of the things that we released, which I think, yeah, did get a bunch of eyeballs on it, is just around how important those small checks are to early stage rounds in particular. So the way that we define angels in our database, and this again, the definition isn't set in stone,
Hmm.
is any individual that's investing in a from not an institutional VC. So you don't have a fund behind you. So any individual investor, and then you could make a case about the check size, anything $20,000 or lower, we would say is definitely an angel investor. 25 to 50, maybe a big angel, above 50 to 100. You're talking about a high net worth individual who maybe is angel investing on a more regular cadence. And that cadence part is important. One of the things
Hmm.
that we saw from the last couple of years is that angel investing as a concept actually exploded during 2020 and 2021. So many more people introduced to the idea of angel investing, so many more people cutting their first checks, usually on safes, to these early stage startups. And then over the downturn that hit in early 2022, we have seen some of those angels sort of remove themselves from the market, but it's still at a higher baseline than it was back in 2020. So, some group of people caught the bug for
Hmm.
early stage investing and became really fascinated by it and are continuing to invest, usually, I got to say, at a slower pace than they were before. But angel investing is a more robust part of the market than it was 2 or 3 years ago.
Do you think that's like a from access, or do you think it's liquidity? I don't know. It-
I think, look, we were talking a little bit off mic about how some of this data, when it's released, can expose a little bit of lack of knowledge about what venture is really about. I got to be honest. I think a lot of the angels who tried their hand at angel investing in 2020 2021 probably didn't have as great a conception of one, the risk that this entails, given that everything was up and to the right at that time. And then two, the
Mm-hmm.
time. The time frame is so long. And if you are just coming into this having invested in other kinds of things, I think it's difficult to understand the scale of the patience necessary to make some real gains here. And so
Yeah.
if people weren't seeing, saw like some significant declines in some of the companies they invested in early on, they may have just said, look, this is, I have other things that I can do with my cash.
Yeah. I mean, there seems like there's something there too with, like in public markets, if you read a financial book, they sort of tell you, right, like you don't want to buy when it's high and sell when it's low. But that's kind of the typical behavior. That's why most people can't, outperform the market. And especially when you
Yeah.
account for the fees and there's a lot more public data. Is it kind of the same concept here? Like if you were investing in 2021 when the market was, ripping and then you kind of pulled back in 2022, is there data around like, oh, you should have stuck it out? Or is it just more of that's a better strategy that like if you're going to get into angel investing, you have to be ready to do it for 3, 5, 7, or maybe even 10 years, because I think that window has gotten longer too, right?
Definitely. I think that latter point is probably the main one, which is it is almost impossible to be a good angel investor if you're going to do this for a couple of years.
Mm-hmm.
You have to have a breadth of your portfolio, and you have to, just like with VC funds themselves, there is something we know when you look across fund performance or syndicate performance, one of, if not the major inputs to that is just the vintage year. And that's
Mm-hmm.
very unpredictable. So you have to invest across multiple vintage years. You have to have some time diversification in your investments in order to make that real. Is it better to invest in the, right after the crash? Probably. It's going to
Yeah.
take a while to see how these new companies are doing, but I would bet that at least you're not dealing with the huge valuation overhangs that you were in 2022.
Yeah, I mean, I think one or two things that we consistently hear from, in the 50 plus episodes we've done from all of, especially the angel investor guests is, I wish I would have done smaller checks and then I wish I would have invested over a longer period. But it's really hard. Like, I'll totally own it. Like, I kind of joke with everyone now that I have a small fund that I invest out of. I used to invest angel personally, and I realized, like, oh, wow, I don't make nearly enough money to keep
Mm-hmm.
doing this and not really patient enough. So even if you kind of hear everyone telling you not to do this, how to do it, it's really hard to go out there and then do that.
It's super, super difficult. And the question is really like, what does angel investing mean to you? Is this something where you're doing it with the express purpose of trying to make a huge profit? Is it that you want to be deeply involved in a specific part of the tech ecosystem? And this is a way that you can stay up to date with the latest founders, the latest trends, the latest tech, and like kind of make sure it's almost like you're paying for the learning exercise. There's a lot of different reasons why people might angel invest. If it's for pure profit, you got to do a lot of it. Probably you got to take a lot of
Yeah.
shots on goal.
I don't know. I joked like a while back that like angel investing is like just expensive newsletter checks.
The most expensive newsletter subscription you can
Subscription,
possibly
there you
buy.
go.
Yeah, exactly.
Well, so one area that would be interesting to dive into a bit, because Harry and both and I have like small funds, and I'm in the middle of fundraising mine. And I think one of the really hard things to figure out is like what is good. And I think
Mm,
your most recent report, your VC fund report that came out, really kind of shed some light on it. And granted, it's across many different, fund sizes and things like that. But even just like, I was going through the exercise of like, how is my angel portfolio doing from like an IRR perspective? And is
yep.
that good or bad at this point in time and age and all that? And I think it was just, yeah, without even your data, it was just like, I don't even know how you answer that question, right? Or even how
Right.
even an LP or anyone even assesses that.
Right.
So anyway, that wasn't a question there. It was just more of like, it's so murky. I'd love to hear like what you out of those like out of that report specifically, like what you found to be the most illuminating, kind of like the most interesting data points because it got a lot of press and
Did get a
people
lot of press.
spun it however they
Uh,
wanted to spin it, or or refuted it, or didn't refute it, or had
yes.
small sample sizes to extrapolate against. All the things.
Opinions were strong, that is for sure. But it was great. It was the first time that we've actually put out any data on fund performance this way. And I think the context here is that the vast majority of the funds that are included in that report are less than $100 million in AUM. So they're small funds and they're from fairly recent vintage years, like 2017 onward. So a couple points came out of that that gendered a ton of conversation. Number one, how can you judge fund performance, as you mentioned, in the early years? Do any of these metrics, IRR, TVPI, et cetera, do any of these metrics matter in the first 5 years of a fund? Or is it really you invest, you wait, and then you start judging performance in year 8, 9, 10? Lots of different opinions about that. I actually had a conversation at an event with Beezer Clarkson of Sapphire Partners, who's a big LP into these emerging managers. And when I talk to LPs, what they say is obviously more data is better than no data, but we really are not, marking down managers who, for instance, have IRRs that are at the 25th percentile in the first 5 years because we've had fantastic funds in the past come out of those vintages or those profiles. And similarly, if you're really crushing it on IRR and TVPI in the beginning, it's not a guarantee that that's going to be where your ultimate fund performance ends up. So, I think one of the useful things about having this data is one, yeah, you can plot yourself along the line, but two, it sparks the conversation of, okay, if data like IRR and TVPI isn't what our LPs are going to be judging us on, how can we prove that we're doing what we said we were going to do? And that phrase is something that LPs tell me all the time, which is I judge my managers based on whether or not they did what they told me they were going to do. If you said you're an enterprise SaaS investor and your portfolio is full of space tech companies, I'm going to ask why. If you said that you were going to deploy capital over a 24 or 30-month period and you're almost done with deploying capital, it's only been 12 months, I'm going to ask why. Like all of the things around the metadata around investing, I think are the questions that we hear a lot from LPs for emerging managers. And then you can talk about performance once these funds get a little bit more, healthy or mature.
So it seems like there's almost some KPIs that you could set that are more binary, like your focus, right? And then each company that you invest in, does it fit into that category? That's a great example because like you said, like I've personally, been an LP, very small LP, in funds where, the net IRR probably IRR, during those hot times, 2019, 20, micro fund, 10, $20 million was killing it, 200, 300%.
Yep.
I'm like, oh, well, here's another 25K for your next fund, right? And now
Yep.
those
Yep.
numbers are not looking so good. So, it could be like, right, doesn't look so good. And then, like you said, right, it could have a very, minimal IRR. And then if they hit one big, later down the road, then obviously it looks really good. So I kind of agree. I do think it, I don't know. I'm a little torn. Like more data is better, but I don't know. Does it matter?
There's a there's a part of it too where, and this I think was reflected in the founder experience over the last few years, where founders felt on top of the world, those of them that were raising, sometimes multiple rounds per year in 2021, and everything was shooting upwards. And then the retrenchment came, the downturn happened, and these founders are left with probably overvalued companies. They have to make really difficult choices about down rounds, et cetera. One of the things that I think our data did occasionally was kind of give them a little bit more permission to do that, to say,
Mm,
look, this is about a macro change in the economy, in startups in general. Yes, you are responsible for your own performance, but 25% of all the rounds on Carta for a couple quarters there were down rounds. This isn't
hmm
just a you thing, for instance.
mm,
And that can happen on the fund manager side too, where they are looking around and they have even less data on how they're performing. And so when they go back to LPs, they get really nervous. Like, I don't know where I sit. Are they going to be really frustrated? Whereas this data maybe helps illustrate a picture of, look, everybody pretty much is down. Where do you fit in that lower landscape? Maybe it's actually better in terms of where the percentiles than you thought. So maybe this data can play sort of a reality grounding role in that way.
I have I have so many thoughts on that being like mid-process in fundraising with
Mm,
fund performance and hearing feedback live from a lot of these like fund to funds and things like that. I think the thing that I really struggle with, if you specifically if you're an early stage focused fund where you're like, hey, look, I'm trying to be first institutional check or pre-seed, is the reality is that your landscape is all safes and
yep,
there's this world in which many talking heads and known investors say it's not real until there's a like a priced round, and it's like, okay, I hear you, right? Because that's like an actual equity sale and we priced it like totally. But the
sure,
reality is that safes in the past 5 years have gone from nothing to everything, and it's like a new landscape. And so you hear a lot of advice like, oh, don't include a safe markup in your, TVPI calculation and the reality is that, I see both. We've
yep,
had markups on like a priced round, and I feel really solid about that because obviously it's a number. But I've also had companies that have marked up on safes, and honestly, the companies that marked up on safes, I've been like, well, they're actually, if from my knowledge of those businesses and what's going on, are actually performing probably the best. And they were like, it's just easier for us to do insider rounds on a
yep.
safe and like not go through this whole process right now of doing a priced round. And so I just don't think that like that conventional wisdom reflects a new reality of like convenience for founders on and just the norm of how you can raise. But also like how much like I was thinking through like because we've DM'd about this, Peter, a little bit. Is like it's not the conventional wisdom to use safes, right? To mark up things. But I was thinking that
Yep.
if you have a new investor come in at a higher safe with like an amount that's either, a higher like, a higher dollar amount than the original safe that you put in on, like total
Yep.
raised or something like that
Yep.
actually constitutes almost a whole new valuation because someone else externally came in, did that. And so I don't know, I've been trying to think of like a path forward on all this to kind of get at this problem.
I think, Colin, you made a couple wonderful points there. And I think the general feedback, like, yes, in the aggregate, having a policy where you just take any markup on a safe is probably, if not disingenuous, then maybe not the best policy or certainly not the most conservative policy. Some of this just gets down to the communication with LPs to say, look, if I invest on a safe and it gets, the company goes on and raises another safe before a priced, if that safe is A, from an external fund, B, for a significant amount of money, and C, at a valuation, quite a bit higher than ours, I'm going to probably take that as a great mark. If not, I won't. And I think there's a whole range of feedback. Some LPs may like it, some LPs won't. I know some fund managers who are effectively keeping, if not two sets of books, then like two stories, right? Our books say we're going to hold this at par until it's marked up by a price round. But the story of progress is, yes, they raised again on a safe, and here's some underlying Portco data on revenue, et cetera. We think this is a real winner. So it's like incumbent upon the fund manager in an annoying way to like be to have both sets of facts in their head and to be able to speak to both. I agree with you. Like safes are. I know everyone talks about safes. I think it is still underrated the degree to which the landscape has radically changed from even 2019 or 2020. Just in the use of safes, multi-round safes, the way that they are being actually inserted in between price rounds as, convertible bridge or extensions. Like they're just all over the place now. And it's like a whole bag of worms that people have to kind of figure out how to talk about.
Peter, you mentioned story, right? I think a
Mm.
lot of VC and startups is really story, the narrative. I mean, literally, when you start a company, you're like pitching some crazy story, like here's how the world is
Right.
going to be or how it's going to change. How do you
Yes.
think about that? Like, it's kind of the opposite of data, really, like, and what you do and what you focus. Like, I'm like, no, don't look at the data. Like, think about what this could
Mm.
be and balancing the two, right? Like, I could kind of see that, okay, if I'm trying to raise, I'm an emerging manager, I'm trying to raise the fund, I've got a bunch of angel investments that I did. And, now, just like you said, a lot of people are doing safes and we're getting markups on safes. Obviously I kind of want to use that because then it makes my numbers look good,
Right.
right? Or look better. And I don't have a lot to go off because I'm new, I'm emerging manager. So how do you
Yeah,
sort of balance the like, this guy's full of crap with, or the girl is full of crap with, the sort of like balancing it in reality. But, at the same time, like you're hustling, you're trying to raise money or you're trying to raise a fund.
definitely. I mean, my tagline on LinkedIn these days is data storyteller. So I
Mm,
think you need both. You have
okay.
to ground yourself in some sort of reality, but just like it is for early stage founders, it is incumbent on the emerging fund manager to paint a picture of the future that LPs can that resonates with the LPs that they're speaking with, and then explain why they are the person that can sort of be the hinge point to that future. We see something other people don't. We have access to deals that other people don't. We believe that this is an underappreciated segment of a market that's going to be huge. Like the storytelling,
Hmm.
we just, we spoke a little bit at the beginning about this, like early stage venture data. It's great that we have it, but a lot of it is directional at best, like these companies take valuation. A company that's worth $15 million post money today, no one is hoping that that company is actually worth 15 million post money. That would be a real problem. It's the goal is to get it to a billion. So like what it is today and where you're going is all about projection and storytelling and
Hmm.
persuasion. And that I think is something that it's like the underlying skill for both early stage founders and early stage managers. How can you weave these data points into the right narrative for yourself and for your company?
Yeah, I sort of like the idea too. I mean, Colin, I guess I reviewed your deck recently, so I won't spill all the beans, but I like the idea of, if you're presenting, your IRR, your returns, and if you have got a really good, like if you, maybe that's the story you're presenting, but if someone dives in, like a very savvy, potential LP dives in, is like, tell me about how you calculate this, you got to be ready to go and say, hey, this one is based off of a safe markup, but I have access to the internal metrics. They're growing at 20% month over month, and look at their revenue and look at that. And so like I think you can justify a higher valuation here, not just because some guy put in a 25K angel check, at a higher
Right.
valuation, but you actually have, obviously if it's a price round too, that's sort of the maybe more of the gold standard. But I think if you kind of
Yep.
have that like ammo ready in your appendix, or because honestly, Peter, I feel like in my experience, most people are kind of more on the surface. Like they look at like what looks good, what sounds good, are you having a good pitch? And
Mm,
like, I don't know what percent of people dive into that next level, but I don't think it's the majority.
interesting. Yeah, I
What do you think,
love the
Colin?
idea of a
Yeah.
I mean, the appendix thing is I think sometimes the magic bullet where okay, you're telling a story, you have a ton of data, but you don't want the data necessarily. You don't want to get bogged down in too many details. You want to be high level and broad and bringing people along with a vision. And then the appendix is like you've anticipated all the questions. So, oh, well, what about this? Oh, I'm so glad you asked. Let's jump to a
Mhm.
slide that I already have where I detail all my stuff on that. That even when you're just talking about logistically, how do we tell a story? That's a beautiful way to keep things focused, but also show expertise. You didn't need to show the expertise up front because you felt confident. Look, I've already got this answered. And if we need to dig into it, we can.
Yeah, I think the what's been interesting to me with the fundraising process is I think we all know this that there's different types of LPs for fund managers, right? So there's kind of like I don't know, a couple buckets. Like one that I would call like people that are like in the tech industry or in startups and just understand it and have some money. Then there's like high net worth individuals that aren't necessarily in startups or tech. And then there's
Mhm.
like family offices and fund to funds. And I see
Yes.
a lot of the conversation, around like TVPI, IRR, like all centers around probably that fund to fund bucket and then somewhat into the family office side. And then I think there's some sophistication in the high net worth and like in tech, but
Yep.
largely those are like wildly two different buckets of people that you talk about from like fundraising, where it's like the people that are like in tech and startups and maybe in specifically whatever you're investing in, they're investing in you, right? and in your picking ability. And also usually because one, they can bring you deal flow. They
Yeah.
want to go, involved with those companies. And so it's funny is that a lot of those like slides and performance are more of like a checkbox that they're going up and to the right versus when you go talk to these more institutional investors, they're like, they actually want to like, they care less about, they do care about your story and everything, but they, like to show me the data, right?
Show me
And
the
show
data.
me all of that. And I find it funny that there's those two different buckets and one gets heavily indexed on, but in reality, like a lot of like early stage funds or emerging funds or managers funds, whatever, a lot of their money comes from that bucket of people that probably care less about the data in the sense
Yep.
that like it's just they're more believing in the mission. Whereas
Yep.
as you go bigger and bigger fund size, you get more and more into the family office and fund to fund bucket. It's kind of like Nicole Wishkoff shared her like fund one, two, and three, like what, basically the percentages that came from each. And it was like
Yep.
actually going down over time from individuals, right?
Yeah.
So
I think that's pretty, I think that's pretty expected. I do find it pretty, I'm interested in how fund managers decide which kinds of LPs to spend their time with. Or like, when is the right time to start bringing in institutional LPs? Do you have to have a track record in order to do that? Are there ways to build relationships with them beforehand? I think that sort of fund or LP construction, LP portfolio construction is a sort of unexplored area. I don't know if we have great data on it yet, but I want to like dig into why people make those choices.
Yeah, that would be interesting. What, as we wrap up here, Peter, what are some interesting benchmarks that are out there, maybe for angels or for emerging managers that have stood out to you recently or that you don't think a lot of people are talking about or that you're kind of looking towards in the future?
Yeah, I mean, I won't speak on our own book for the entirety of this answer, but certainly, we've got a ton of data at Carta for this VC fund performance report being the big one for emerging managers. I think on the angel side, it's really that is even maybe more murky. You can look at data on what's going on in the pre-seed and seed part of the US startup market, but even there, to Colin's earlier point, safes have screwed things up in the reporting of this stuff. So both in terms of how is a syndicate doing, for instance, but also how is a company doing and can that company's fundraising be tracked in a useful way. So if you look at, say, the standard bearers for data, PitchBook, Crunchbase, I think that those folks do a really wonderful job of aggregating fundraising data for later stage companies. When it comes to safes, because they don't have to be reported, it's a
Hmm.
lot more difficult. So, we have some of that data on Carta and we produce state of pre-seed reports, but you can also get some of it from like, I think some angel groups do a good job of talking to their members. I'm thinking especially of like angel groups that are associated with some big companies, Air Angels, Uber Angels, that kind of stuff. I've attended some sessions there where they've put out some really interesting data on how their companies are doing. And then the other way is from like the accelerator side. So keeping a close eye on what obviously YC, but even more so if you're in Silicon Valley, like there's been an explosion of small incubators, accelerators
Hmm.
attached to VC funds, accelerators or that don't even call themselves accelerators. They're more like co-founder matching programs that then also take a little bit of equity. So we've like gotten more ensconced in some of those places, and some of those people are tracking data in a really, really cool way. F dot, for instance, here in the Bay. I don't know, if I was a founder, I think right now is dizzying the amount of different places you could go for
Yeah.
fundraising and advice. I don't know how they make the choice between, say, one accelerator and the other, outside of perhaps YC, where you just go for the brand name.
Well, if I was a founder, what might I look for or what might kind of insights be helpful or useful to me, do you think?
To make that choice. You know, I think outside looking in, if you're not part of the Silicon Valley ecosystem already, it can feel very attractive to join an accelerator based only for the network, right? You're
Hmm.
coming so that you can become a part of this ecosystem. I actually don't think that's a terrible reason. What I would really caution founders against, because we've seen this a little bit in the data, is there is a cohort of founders who have done two or more accelerators, and that doesn't make any sense to me. Um, I don't know what they're teaching you at the second or third or fourth, I have seen that fourth accelerator that you wouldn't have already picked up. Maybe if it's a hyper specific industry related one, it's possible. But in general, the accelerator programs, you're going to learn a lot of the same information. It's really just about the quality of the network, the quality of their ability to help you fundraise afterwards, that kind of stuff, which is why, YC continues to like hold the pride of place that it does.
Yeah, I think my perspective on the accelerators and seeing people do multiple is that they are kind of a proxy for fundraising at early stage. Like they're just like ways to get fundraising. A lot of founders look at it, I think,
Hmm.
which tells me that
Expensive ways to get fundraising in terms of the equity, though.
totally, but that just tells you about how hard it is to get early
Well,
stage funding.
I think that's
Yeah.
sort of the thing, Peter. Like, obviously, you don't want to give up whatever percent of your company, but if you don't have any other option, right? Like, that's sort of where it's like,
Yep.
oh, you want to maintain this percent of ownership, and you're like, dude, no one will give me money. I gotta tell you, I don't like. I might have to give up
Totally.
50%. You know what I mean? If it's like the difference between not having any money and having something, it's where do you draw the
Yeah.
line? It's really tough.
Yeah. I got to check
Yeah.
my privilege on that answer a little bit. Yes, you're right. If you absolutely need capital and this is the way to do it, then that's what you got to do.
Well, I think overall, I mean, a part of my fund insight, I think, for like why I'm doing my fund, it, specifically was the reason that like there is a hole in like pre-seed funding for marketplaces specifically. Like there's just not
Mhm.
an expert and someone that knows them well. Like YC, like gets a lot of them. Techstars probably got a lot, like they're kind of like more generalists accelerators, but they soak them up, right? And then they kind of get credit for, oh, you picked marketplaces, right? But there's actually no one that like, I think five of the top 10 YC companies are all marketplaces ever.
Yeah.
And so the point being is that there's no one really owning like just writing that first large check, like first institutional check at like pre-seed family friends type round. And I think in other segments there are, like in SaaS, there just isn't more developed kind of pre-seed funding there. So I think overall what you're seeing is more specialization and potential ownership at the really early stage by emerging managers in those segments. And that's kind of what I'm expecting to see because it's also probably the only place they can really like eke out alpha in my mind with
Yeah.
lower fund sizes and high ownership percentages is investing earlier and earlier at lower valuations, right? So I don't know. That's kind of like where I was expecting everyone to go in my mind.
The problem with that is there's only so early that any of these funds can go and raise the size fund that they want. Like obviously the fund
Mhm.
size dictates the strategy, and you cannot really be $1 billion pre-seed fund unless your only option is to like take unless you're funding every other company that you see. It's just like the math doesn't make sense. And to be honest, some of the way that some of the bigger funds, multi-stage and others, have come down into Series A and then seed and maybe even a little bit of pre-seed, there's some pretty, I think, salient debate about how that screws up the market for other funds who don't play the multi-stage strategy. And it's not necessarily good or bad, but it has real deep impacts on, for instance, are these big multi-stage funds merely taking option calls on a lot of these companies? And you're just, those founders are competing with signaling risk later on. If they take a check from a multi-stage and then that multi-stage doesn't, end up leading their next round.
Hmm.
Pros and cons, lots of debate about how that's
Yeah.
working.
I think that, yeah, like I kind of view the emerging bucket as two. One is like the artisans, and then one is like the
Mm,
scouts. And so there are a lot of what I'd call like scout emerging managers that get funding from like, just a larger VC or like people like GPs that have been around a long time. And so those ones, I think 100% are basically people putting capital to work to get option calls on things
mm,
and can have, varying levels of success, but also like weird signaling risk, like you mentioned.
yep.
But I do think like kind of my point is more of there's like this artisan segment of people that are like experts in their particular area and can get by maybe doing it at like a $20 million fund or a $40
Mm.
million fund, but they're going to inherently have to have a smaller team, smaller, just everything has to be smaller. That's the only way I can see it being defensible and makes sense for LPs. But then again, it makes it really hard for institutional LPs to come in when you're doing, a small fund like that. There's a very
Yeah,
specific set of institutional funds that, or institutions or funds that can do that kind of that fund.
yeah, totally.
Awesome. Well, Peter, really appreciate all of the insights you shared. We'll leave a few links in the show notes. I think we talked about the VC fund report quite a bit, so we'll leave a link to that. I know you post a lot on your LinkedIn. You active on Twitter also?
I am, but I
Okay.
candidly try to
Maybe
spend
we'll
less
just
time on
okay, maybe
Twitter.
we'll
It's
just
just
post your
hard.
LinkedIn so no one bugs you on Twitter.
Yeah.
Anything else you want us to link to or mention or leave us with?
No, I think that those two places are fantastic. I really enjoyed the conversation today, guys. Thanks for having me.
Awesome. Yeah, no, I think we really appreciate all the data that you're releasing. And I really like the point that you made about sort of, giving founders these benchmarks, giving them this data that so that they can kind of use that, go out and craft their own story. So I think, Colin, you and I, we've got some work to do and we'll get back to Peter now that we've got a direct line to his email. Thanks, Peter.
Thanks, Peter.
See you in the inbox, guys.